Welcome to Brad Explains the Law. In this video, I'm going to explain the Special Purpose Acquisition Company, or SPAC, and why they are exploding right now. But first, this video is not legal advice, and I'm not your lawyer unless I agree to represent you and we sign an engagement agreement, and this communication does not form an attorney-client relationship. Now, back to SPACs. SPAC stands for Special Purpose Acquisition Company. A SPAC is a company that does an initial public offering registered with the SEC, but it doesn't own any assets other than cash. It doesn't have any income. It doesn't have a business, but it has big plans to buy someone else's big plans. I'll explain that later. SPACs have been around for a while. They used to be called blank check companies, but they fell out of favor in the 1990s when they were used for a lot of penny stock scams. So at that time, the Securities and Exchange Commission passed a rule 419, requiring that money raised in a blank check IPO had to be held in a trust account until the company acquired a target business, and the money had to be paid back to the investors if they wanted it back. So after Rule 419, blank check IPOs kind of languished for a while. And now, one difference between a traditional old school blank check company and a SPAC is that the SPAC promises to make an acquisition within a set time after its IPO, usually 18 or 24 months. And if it doesn't make an acquisition, it will return all the investments in the IPO to the investors. So a SPAC is a renamed blank check company with a few special features. And SPACs have been booming in the last few years. I don't want to get too bogged down in statistics, but these numbers might help explain what's going on. SPACs were 20% of all IPOs in 2019 and almost 40% of the IPOs in 2020. They raised more than $10 billion in 2020, and 2020 was the first time more money was raised in SPACs than in traditional IPOs. Also, 2020 had 4 times more SPAC IPOs than 2019. 2021 is on pace for about 1,000 SPAC IPOs based on January and February totals, far more than the projected pace of ordinary IPOs, although those are coming on now too a little bit. I'll discuss that later. To explain why SPACs are booming right now, I need to explain a little bit about what happened to traditional IPOs over the years. So, successful companies rarely go public anymore until they're older and really big. A traditional IPO has become very expensive. It takes a long time, 6 months to a year, going back and forth with the SEC, and they're becoming more difficult and less common. The IPO process includes up to a year of negotiations with underwriters, investment banks, investors, SEC review and revisions, intense scrutiny of the financial statements and business plans, and the executives have to go on road shows, and it's so time-consuming and distracting that only really large companies can afford the time, the distraction, and the money. And then, after the IPO, your share price might go into the tank. You know, it wasn't always like this. In the 70s and 80s, financing a company through an IPO was more common. Those decades are averaged around 300 to traditional IPOs a year. In the 1990s, IPOs really boomed. There were 5,742 IPOs during the internet and telecom bubble. Then Enron ruined it for everyone, and the Sarbanes-Oxley Act was passed, and as a result, the cost and the time and the expense both of doing an IPO and of being a public company after the IPO went up, 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 and IPOs and the number of public companies went down, down, down. And the number of exchange-traded companies decreased from more than 7,000 in the mid-90s to only a few thousand in the 2000s, and it's up to 6,000 now. And IPOs went from almost 600 per year in the 1990s to about 200 per year from 2000 until recently. And the size of IPOs has grown. IPOs between 100 million and 300 million are pretty rare now. And IPOs over, for example, 10 billion have increased quite a bit. But the reduced number of public companies is also sort of misleading because non-exchange traded companies have actually increased dramatically. NASDAQ used to be the exchange for startup and growth companies. And a few years ago, it changed its rules and dumped all those smaller companies. And now, as a result, now there are 11,500 smaller companies trading on OTC markets. That's the over-the-counter market. And that amount is double from 2010. So when we say there are a lot fewer public companies, we're talking about companies traded on NASDAQ or on the New York Stock Exchange. And it looks like 2021 might be a rebound year for traditional IPOs too. Still, traditional IPOs are tough. The pricing is unknown until closing, and everyone's trying to push your price down, and failed or somewhat disastrous IPOs have become more common than they used to be, particularly back in the 90s. WeWork had a big failed IPO. Uber had a huge price stock drop after their IPO, although it's recovered now. A company called Wanda Sports did an IPO in July 2019. They only raised half of what they wanted to. Their price tanked, and recently already they're delisted by NASDAQ and going private. But Wanda Sports was an event company, and they were sort of killed by COVID, so that's an exception. Anheuser-Busch tried to spin off its Asia operations and had to pull the IPO because of pricing problems. Eventually, they were able to pull it off a few months later. So that's what happened to traditional IPOs over the decades, which has led somewhat to this growth in SPACs. So how does a SPAC work? A SPAC is formed by a group of people, the sponsors, with previous success in investment funds in particular, also operating and managing companies and financing companies. Hopefully the sponsor team has experience in all of those areas, along with either an experience or an interest in a particular industry. For example, healthcare technology, biosciences, and cannabis are particularly strong SPAC targets right now. The SPAC raises money through an IPO, creating a public company listed for trading on a stock exchange. Then it searches for an acquisition target to purchase or merge with, usually in the industry segment the founders have experience in and that they've targeted with their IPO. We're not talking about penny stocks, and we're not talking about helping finance entrepreneurs or small startups. SPACs are raising hundreds of millions of dollars in their IPO, so they're looking for bigger acquisitions, and a few have raised more than $1 billion. So again, they're looking for big acquisitions, big private companies. Normally, the SPAC's IPO price is $10 per share, and even though it's listed for trading, the price normally stays around $10 after the IPO until they find an acquisition, because it only has cash in the bank. There's no profits, there's no losses, there's nothing going on to cause the price to change. The IPO is usually common stock with a warrant or a fraction of a warrant. A warrant gives the holder the right to buy common stock in the future at, say, $11.50 per share if it was a $10 offering. And you can usually start exercising the warrant about 30 days after the acquisition of the target. So a couple of months after the IPO, the warrants will start trading separately. And under SEC regulations, a SPAC can do its IPO more quickly and more cheaply than a traditional IPO, because the SPAC files a registration statement with the SEC just like for any IPO. But since it doesn't have any assets or operations, it only has big plans, the registration statement is short, and normally the SEC reviews it and approves it pretty quickly, much more quickly than a traditional IPO. Mostly the SEC is going to be focusing on disclosure of potential conflicts of interest by the founders and fees and compensation to the founders in particular. SPACs also get to file their SEC registration statement in what's called the emerging growth company tier, which means it has less audit and financial statement disclosure requirements than larger operating company registration statements would have for their IPO. Most SPACs are listed on NASDAQ. A few big ones are on the New York Stock Exchange. Both exchanges have special rules for SPACs, but I won't get into that here, too much detail. After the IPO, the SPAC has usually 18 or 24 months to acquire a target company. If it doesn't, has to return all that investor money. Also, once the SPAC finds a target business and negotiates the acquisition, if an original purchaser in the IPO doesn't like the deal or the business, they can return the shares to the SPAC and get their money back, and they get to keep their warrants. Now that's a pretty attractive deal for SPAC IPO investors, which are mostly institutional investors. Look at it this way. If I run a fund or insurance company with billions of dollars, I can park some of that money with a SPAC, founded by financial people I know and trust. My money will earn interest. I can get my money back with interest anytime before a target is acquired. If I don't like the deal, I can get my money back with interest and keep the warrants. With my warrants, if the post-merger company does well and the stock price goes up, I can exercise my warrant to buy stock at the original warrant price. Just for example, let's say the stock price goes up to $20 per share, but I have warrants to buy at $11.50 per share. And so I can exercise the warrants, buy and sell that stock for a profit right away, or hang on to it, or mix and match. If I'm comfortable with the business the SPAC bought and want to take the risk, then I just leave my money in. And SPAC share prices tend to be more stable after the target is acquired than traditional IPO prices. So there's less risk than I would have if I'm investing in a traditional IPO. Also, underwriting fees for a SPAC IPO are less than a traditional IPO, but then the underwriters get additional fees in the follow-up PIPE transaction. A lot of acronyms floating around. I'll explain that in a minute. The acquisition or merger is called a de-SPAC transaction. So it's not a special purpose acquisition company anymore. Now it's a real company with a real business, so it de-SPAC'd itself. If the target agrees to terms with the SPAC, then the SPAC has to go through the public company merger process, just like any public company. You have to prepare a proxy statement for the SEC approval. That takes 3 to 5 months going back and forth. Then you have a shareholder meeting to approve the de-SPAC deal. Then you have to file a disclosure document. It's called a Super 8K with the SEC. It's almost like an annual report to get all the information out on the new business that you've acquired, including financial statements and so forth. But to close the deal, the SPAC will probably need more money than it raised in the IPO for at least 3 reasons. First, remember that all the investors in the IPO can demand their money back at this point at the time of the de-SPAC. And many investors often do, so it will have less money than it raised in the IPO. Second, if the price for the target is more than the SPAC raised in its IPO, it's going to need more money to close the deal. Third, the target may need operating capital after the deal closes. That's where the PIPE transaction that I mentioned earlier comes in. PIPE is an acronym for Private Investment in Public Equity. Basically, the publicly traded SPAC does a private placement of stock, which is usually purchased by some of its original IPO investors who are going to stay in the deal, and by new investors who like the deal, who like the new business that it's going to acquire. Then the deal closes, the de-SPAC transaction closes. And the result is you end up with a private company is now a public company without having to do an IPO. The founders and shareholders of that private company now have some liquidity, eventually, not immediately, because they'll have what's called a lockup agreement that will prohibit them from selling shares for a little while after the acquisition closes, but eventually they'll have liquidity. And the original investors in the SPAC IPO either, one, have their money back, plus interest, plus warrants, so they can buy shares in the future if they want to, or 2, now they have shares in a public company that should have a lot of potential upside without the cost volatility of a traditional IPO. And of course, the SPAC founders make out very well. They invest hundreds of thousands of dollars to form the SPAC and do the IPO, everything that goes into that, and that money there is at risk. So they are typically compensated with pretty large stakes in the public shares of the acquired company, often up to 20%. So that's how a SPAC works in a nutshell. More like a big bag of nutshells. Compared to a traditional IPO with all of its price risk, a de-SPAC transaction is a negotiated merger or acquisition by an already public company, the SPAC, at a fixed negotiated price. You don't have that whole pricing thing like you have with an IPO. And the founders of the target business can get paid some cash in the de-SPAC transaction if they want to sell some shares, which you can't do in a traditional IPO. And because the de-SPAC transaction is a merger or acquisition and not an IPO, the target company can talk about its financial projections to investors just like you can in a private placement. That helps support the SPAC share price after the de-SPAC transaction. You know, projections are very risky in a traditional IPO because the underwriters, the founders, everyone involved has a higher risk of liability if those projections aren't met after the IPO. And the SEC hammers projections like crazy if you have them in your registration statement during the review period. Us IPO lawyers really wave the red flags at our clients. You can't put in projections, no projections, you'll lose everything. Not true with a SPAC, de-SPAC transaction. So let's say you've built a mid-sized, profitable company, and you would have done an IPO back in the 80s or 90s. You're at that stage, but you don't want to go through the hassle and the risk and the expense now. So you're approached by a SPAC for an acquisition. Well, you can look at that SPAC a couple of different ways. They might be sort of like a bunch of leprechauns throwing pots of gold at you. Or you might look at them as a bunch of vultures circling your company. Which is the better view really depends on who the SPAC is. Who are the people? What is their history? Are they vulture capitalists who quickly cut costs, maximize profits, and then dismantle the company, sell stuff, and maximize their cash? Or do they have a history as company builders with longer-term investment objectives and people who build jobs and build companies? And what fits your profile? And there have been some SPAC successes for sure. DraftKings went public through a de-SPAC and its share price doubled. Virgin Galactic did a de-SPAC and went public. Its shares were really volatile, but they stayed strong. We'll see if that type of success keeps up as all the 2019 and 2020 SPACs go through de-SPAC transactions in the coming months. To wrap up, the stock market and the IPO process have changed dramatically over the last couple of decades. It's mostly for big, older companies now. There are fewer publicly listed companies on NASDAQ and the New York Stock Exchange. For example, in the late 1990s, young companies were more than 57% of exchange-listed companies, and it's down to around 28% today. New startups stay private much longer than they used to. But the boom in SPACs might reverse that trend a bit now because SPACs are going to have to acquire more smaller and younger companies. There's only so much inventory out there. It looks to me like right now there's going to be too many SPACs and too few big targets. So they're going to have to acquire younger, mid-growth size companies. But this SPAC boom is also going to create a whole new series of problems. For example, managing a public company is very, very different from managing a private company in many ways. The required financial controls, the financial reporting, the current reporting of every material event, compliance with SEC rules and regulations, and with the stock exchange rules and regulations. It's a whole order of magnitude more and different than what's required to manage a private company. And you still have to run the business operations. One of the benefits of doing a traditional IPO is the intensive education the company's officers, accountants, and board of directors get while going through that IPO registration process. By the time they finally go public, the employees are usually ready for the change, which is a huge change. On the other hand, if you're a company acquired by a SPAC that's already public and you're suddenly a public company and you have little or no experience in reporting and compliance, it's going to be a very, very steep learning curve and a difficult process, and mistakes will be made in things like insider trading, conflicts of interest, failure in timely reporting. Those kind of mistakes can be very, very expensive in your share price, your analyst coverage and reputation, and enforcement costs, just to name a few. Yesterday, this is March 26th, the SEC announced they were going to focus enforcement on SPACs this year, obviously because of this massive boom. And another thing, after decades of relatively few IPOs and few public companies, I don't know if there's even enough securities lawyers left in the United States to handle an explosion in exchange-listed companies. I'm afraid we're going to be really, really busy. So, there you have it. What is a SPAC and why are they booming? Like and subscribe below, and if you have a question or a suggestion for a topic you would like me to explain in the future, send me an email at the address below. Thanks for watching. See you soon.